So in this video, I wanted to go over with you protective federal income tax returns for foreign corporations, or in this case, it's a Form 1120-F, U.S. income tax return of a foreign corp. So under what circumstances would a foreign corporation want to file one of these with the IRS? It's basically in circumstances where you have a foreign corporation that is engaged in U.S. trade or business in some sort of capacity, but it doesn't give rise to effectively connected income as part of that trade or business. Or if it does, they want to file a treaty claim, right? So like if a foreign corporation, in this case we've got fake London Corporation Ltd set up in the UK, and they're selling products or services into the US. The threshold for U.S. trade or business is pretty low, so that would constitute a U.S. trade or business. But the second prong of the test is always, well, do they have U.S. source ECI, right? That's in connection with that U.S. trade or business. And if they don't, they might want to file this return just to kind of get the statute of limitations started. But also, by filing the protective return, it gives the foreign corporation the ability to take deductions if in the future the IRS audits you and decides that no, you were engaged in U.S. trade or business and you have U.S. source ECI, then you're in big trouble, right? Because if the IRS catches you for not filing and you had to pay tax, they have the ability to tax you on your gross receipts, right? So you're not allowed to take deductions, which would be a nightmare. I mean, you can imagine a business having to file a tax return and pay net income taxes on just their gross income would be disastrous. So in this example, we have a foreign corporation that is engaged in U.S. trade or business, and it actually has U.S. source ECI, but we're going to take a treaty position where we claim treaty benefits because we're not operating a permanent establishment, and so for those reasons we don't have to pay any tax in the U.S. So page 1 is pretty straightforward. I mean, it's just the name of the entity, where it's incorporated, timing, where business is conducted. Right here, item D3, if the corporation maintains an office or place of business in the U.S., check here. In this case, we're saying no, right, because we don't have any operations in the U.S. We don't have an office or a fixed place of business, and again, we're taking the position that we're not operating a permanent establishment within the U.S. So so we're not paying any taxes. Very important that you do need an EIN, right? So you can't file this return without an EIN for the foreign corporation. Otherwise, the IRS will just send it back to you. They won't process it. So if you're a foreign corporation, you've got to go through the process of, you can't do it online, unfortunately. You've got to file the SS4 and submit that via fax or paper to the IRS. Or if it's a foreign corp, you can get the EIN assigned over the phone, right? You're allowed to call the IRS, and you'll complete the SS4 and fax it to them, and then they'll just assign it for you right then and there, and then you're good to go. Okay, so in this section, computation of tax due overpayment, these are going to be blank, right? There's not going to be any taxes due because, again, we're not engaged in U.S. trade or business through a permanent establishment, so we're not going to have any liability, right? So the additional information section, complete all these questions as they should be given your facts and circumstances. So the big ones here are, in item K, at any time during the year, was the corporation engaged in trade or business in the U.S.? We're saying yes, they were, right? They did have a U.S. trade or business given their activities. But in item L, we're indicating that the corporation does not operate a permanent establishment within the U.S. or yes, and then you can enter whatever country you're in, enter the treaty country down there as appropriate. All the other items, most of these are going to be no. And then, so in item V here, disclose the shareholders. In our example, we've got one UK resident that owns 100% of the stock, so we've indicated yes, and then we've attached a statement at the very end of this return that shows his ownership. Item W there, we are attaching the treaty-based return position, Form 8833. And again, this is if you're taking a position that you're not operating a permanent establishment within the U.S., it is a mandatory disclosure, right? You can't just take the position. You got to actually file the return, attach the 8833, make it very clear what treaty articles you're relying upon. Okay, so the rest of it, again, all this is just going to be blank, for the most part, assuming you don't have any U.S. source FDAP income or something like that wasn't properly withheld. This is all going to just be blank. For the balance sheet, we're doing this under a U.S. basis, right? So we have no U.S. situs assets, so all these are just none as well. And now we get into the actual treaty-based return disclosure, the 8833. So we've got information on the corporation, right? So Fake Lending Corporation Limited, the taxpayer ID number, address, and we are disclosing a treaty-based return position as required under Section 6114. And then here we start to fill out the treaty positions, right? So we're relying on the U.S.-UK treaty, Articles 5 and 7, right? So our Article 7 covers business profits, says that a company basically set up in the UK that's doing business within the US is only subject to tax on the profits in the UK unless it's operating a permanent establishment within the US, right? And then Article 5 is the permanent establishment article. Section 882 is the provision that states that foreign corporations engaged in U.S. trade or business and have ECI are subject to tax, right? And so that is effectively what's happening here for this company, right? This is a company that is based in the UK. They sell products into the U.S. And under the title passage rule, it's basically FOB destination, right? So the title is passing to the property within the U.S. and so that makes it U.S. source income. So 882, LOB provisions in 4. These are very, very important. These are always overlooked all the time. Everybody reads only the first couple articles of the treaty and they think, oh, well, I'm a UK company, so the U.S.-UK tax treaty will apply. Not always the case, right? You've got to look at the LOB provisions and see, okay, who are the ultimate beneficial owners of that UK entity? What activities is the entity conducting? And can you still rely on the benefits under the treaty, right? Are you equivalent beneficiaries? Are you qualified persons? Those kind of things. So in this case, we're relying on 23.2F to support the position that the UK resident is a qualified person, and so he is entitled to benefits under this treaty. So in item 5, again, a treaty-based return position that is required for disclosure, and here's the subparagraph for the permanent establishment piece. If we jump back to these are the form instructions. You can also get these if you just look to the Treasury regs. They'll have this item down here, but the reporting was specifically required under these regs. This is what we're doing here, right? That income effectively connected with a U.S. trade or business is not attributable to a permanent establishment or fixed base in the U.S. So if that's what we're relying on, we need to we need to disclose this position on the return, right? It's got to be a specific overt disclosure. Okay. Okay, so let's jump back to the return here. And so down here in item 6, explain the position. This is a bit terse just for the purposes of the example. You should expand upon what's going on with the company, right? What does the company do? Where's it set up? How does it sell products into the U.S.? Give a complete set of facts and circumstances so the IRS can clearly see, okay, what's going on and why are you eligible to leverage the benefits under the treaty, right? Very important to provide as much detail as possible, right? You don't want to leave it to chance. And then here we have just another statement attached where we further elaborate on the position we're taking, right? So this is a company set up in the UK. It's engaged in the business of selling products to customers located throughout the world, but it also includes the US. We have US customers. But the company doesn't operate place of management in the U.S. It doesn't have employees in the U.S. It doesn't do anything like that. It just sells products from its warehouse in the U.K. direct to consumer within the United States, right? And then the catch-all here under this regulation section, if the corp conducts limited activities in the U.S., doesn't give rise to ECI, it can file a return on a protected basis, right? So we're filing this return because we want to say, okay, look, we're taking the treaty-based return position that we're not operating a PE within the U.S., and we're filing this return just in case they, determine that we didn't do something correctly, right? Okay. Let's see what else we got here. And then item 2 there is the shareholder listing, right? The question we had up here, if I jump back really quick, at the end of the year, did any individual own 50% or more of the stock? We're saying yes, and so it does ask us, if yes, attach a statement showing the name and ID number of the owner. In this case, John is a UK tax resident, owns 100%, and he's not going to have a U.S. Social Security number or an ITIN. So I think that covers all of it. Thank you for watching and listening. And if you have any questions, please comment below on the video. I'm happy to help where I can. And please give the video a like and subscribe to the channel. And I look forward to seeing you again. Thank you.